Welcome to the MUFG Global Markets FX Week Ahead podcast with Hardman, Senior Currency Analyst at MUFG. It's Friday, December 30th, 2022, and in this final podcast of the year, Lee reviews FX market developments over the past 12 months. The following podcast is intended for professional investors and eligible counterparties only, and not for retail clients. Any content should not be regarded as an offer to conduct investment business or an investment recommendation, but for information purposes only. Hi, Lee.
Hi, Una.
So, what has been driving FX markets over the holiday period?
Yeah, certainly the main kind of driver over the holiday period is still the market reacting to the surprise decision from the BOJ to adjust their yield curve control settings when they lifted the ceiling for the 10-year JGB yield by 25 basis points up to 0.5%. That is still having a clear impact in the FX market, with the yen continuing to trade at stronger levels. We're seeing dollar yen now moving down closer towards the 130 level as it continues to move further below the peak that we saw back in October at just over 150. So a significant strengthening of the yen has happened over the last couple of months, and we do think the trend for a stronger yen will continue into early next year. That's despite the fact that obviously BOJ policymakers have tried to kind of downplay the impact of the adjustment in their yield curve control settings by trying to reassure market participants that this wasn't intended to tighten monetary policy and was mainly to try and improve market functioning in the JGB market. But similar to market participants, we're not fully convinced by that line of argument. And we do see this as one of the kind of first steps towards a shift towards tighter policy in Japan, which should continue to provide support for a stronger yen going forward. And certainly that kind of speculation over a further shift in BOJ policy is likely to continue at the start of next year, when the Japanese government has to put forward their preferred candidates to succeed Governor Kuroda, whose term ends in April of next year. So that's certainly going to be a pressing issue, which markets are going to focus on to see who the leading candidates are at the start of next year to replace Governor Kuroda. And on that side of things, we have seen reports over the last couple of days suggesting that former BOJ Deputy Governor Yamaguchi, who has been one of the kind of more vocal kind of critics of Governor Kuroda's stimulus program, he appears to be emerging as more of a kind of left field and potential strong candidate to become the next governor, according to the Sankei newspaper. That report suggested that Yamaguchi is attracting more attention as a strong candidate, as Kishida's administration is trying to maybe distance itself from Abenomics going forward. And if we look at some of the recent opinions that have been put forward by Yamaguchi, he has called on the BOJ to make policy more flexible and for the BOJ to stand ready to raise the JGB yield target. So that certainly does suggest that if he was to be the preferred candidate of the government to replace Kuroda, I think market participants would understandably see that as another strong step towards a further tightening in monetary policy at the BOJ after Governor Kuroda's term comes to an end in April. We've also looked back as well over the last couple of years to see what Yamaguchi has said on BOJ policy, and he's also advocated setting a more realistic price goal than sticking to the current 2% target rigidly. So again, a further indication that he would be perhaps more willing to move away from loose policy settings more quickly than would happen under current leadership of Kuroda. So taking that all into consideration, we do kind of agree with the current market pricing and speculation that we do see room for further shift towards tighter policy in Japan. And that's clearly having an impact on the JGB market at the moment as well. The BOJ over the past couple of weeks has clearly had to step up the pace of intervention in the JGB market to defend this new yield target. It's meant that we've seen a record monthly increase in government bond purchases by the BOJ, which are currently on track to top 17 trillion yen this month. So to us, the developments are all pointing towards further yen strength at the start of next year. And even though we have already seen the yen strengthen very strongly in recent months by over 20 big figures against the dollar, we still think it's trading at undervalued levels, and it still leaves room for further yen gains going forward.
And with 2022 coming to a close, Lee, how would you summarize FX market developments this year?
Yeah, I think this year certainly has been a very interesting and volatile year for FX markets. Obviously, for the vast majority of this year, it was very much a story of a strong dollar as it rose very sharply to multi-decade highs against most other G10 currencies. Most notably, obviously, dollar yen, with that rising above the 150 level back in October. And from a fundamental point of view, obviously, the main drivers of that were very clear. We had the appeal of the dollar was boosted by the kind of two main negative macro shocks this year, which were firstly the Ukraine conflict, when that started towards the end of February. And then that was quickly followed by a second shock where we saw a renewed lockdown in China on the back of the spread of COVID there. And that delivered a negative shock to the global economy, which boosted the relative appeal of the dollar. Obviously, from a kind of terms of trade perspective, the US economy has been hit less hard by the sharp rise in energy and food prices than other parts of the world, such as Europe, which again reinforces the case for a stronger dollar. And at the same time, obviously, that with energy and food prices having risen very sharply this year, that's also added to the inflationary dynamics globally, and that's something which initially obviously forced the Fed to raise rates much more aggressively and ahead of other major central banks, which helped to boost the yield pickup as well on the dollar. So all of those factors came together during the first half of this year and led to this sharp run up in the strength of the dollar. However, obviously things have started to turn as we move into next year. Certainly over the last couple of months, we have seen a fairly sharp correction lower for the dollar from the peak back in October. And to us, that is justified. We're more confident now that the dollar has peaked out at obviously very overvalued levels, and is certainly there is certainly room there for the dollar to weaken further, we think, going forward in 2023. And certainly the kind of key fundamental drivers why the dollar strength is now reversing are we see more evidence now building that underlying inflation pressures in the US are starting to slow, alongside obviously the recent pullback in energy and food prices, and more evidence as well of the softening of growth momentum in the US economy, which, when all of those factors are taken together, we do think that gives us certainly more confidence that the Fed can continue to slow the pace of rate hikes further at the start of next year, and then eventually pause that hiking cycle in the first half of next year. So that will take away certainly one of the kind of key bullish drivers of dollar strength from this year. And we also have to look as well at what other central banks are doing outside of the US. And on that side of things, it's also more clear now that other major central banks, such as the ECB, to a lesser extent the BOJ, are now playing catch up with the Fed and tightening policy more aggressively than the Fed. And we think that will continue at the start of next year. Certainly the ECB has been very clear in their latest communication that they intend to continue with larger rate hikes at the next couple of policy meetings. while we see the Fed slowing down the pace of hikes further. So from a at least short-term perspective, that does point to some further downside for the dollar relative to the euro at the start of next year. And then the second key factor, which is also changing fundamentally, is also the more rapid than expected shift that we're seeing in China away from the dynamic zero COVID strategy as they continue to remove restrictions that had been in place on activity. And to us, this means that eventually we will see a stronger pickup in activity next year in China as the pent-up demand is unleashed as those restrictions are now taken away, and that should encourage a stronger pickup in consumption through next year in China, which is we think a positive story not just for China's economy but also the global economy as well, particularly obviously countries which are more tightly linked to demand from China, particularly obviously those in Asia and also the commodity producing countries as well. But in the very near term, there is still a risk in the next month or two that this surge in new COVID cases in China as restrictions are eased, that could prove initially disruptive for activity as households could be more fearful initially while the COVID is spreading more rapidly, and that could lead to some pullback in spending in the very short term. But we see that as only a short-term setback before a more powerful recovery through the rest of next year. So to us, if that more positive story plays out in China from a macro perspective, to us, that gives us more confidence that Asian currencies can continue to recover next year against the dollar, which we see as well also weakening more broadly if China's economy performs better than expected in 2023.
Thank you very much for sharing that insight, Lee. Have a wonderful weekend and a very happy new year.
Thank you, and the same to you.
Thank you for listening to this MUFG Global Markets podcast. Rate, review and subscribe, and reach out to your MUFG sales rep for more information. Come back next year for more insights from the Global Markets Research team.